This video explains the proposals relating to expenses on grants and donations in INPAG Section 24, Part 1. It covers aspects of recognition, measurement, presentation, and disclosure. Another video called Common Model for Grants and Donations explains the key terms used in accounting for expenses on grants and provides a high-level overview of key recognition and measurement principles. It is essential content to view before this video. A link is available in the YouTube description below. This video is likely to be most useful for those involved with NPOs that make grants. Grant expenses is the generic term used to describe expenditure on grants, donations, and similar transfers by grant-providing NPOs. It is important to clarify that in INPAG, the term grant expenses is not used to describe the expenses that an NPO incurs as a result of a grant that it has received, such as grant-funded salary costs. A grant expense is where a grant-providing NPO provides funding to a grant recipient by transferring resources, such as cash, or a service, good or other asset, without directly receiving any resources in return. This may include both grants and donations, which may or may not be for a specific purpose. This differs from procurement or purchasing arrangements, where a grant-providing NPO gives resources to another entity or individual, directly in exchange for a service, good, or other asset, in return. A grant-providing NPO may receive services, goods, or other assets directly for its own use, with a worth that is higher or lower than the resources it transferred. If not of equivalent value, and the difference in value is material, the grant-providing NPO may need to recognize part of the transaction as a grant expense, and part as purchasing. For accounting purposes, grant arrangements are classified as either an enforceable grant arrangement, an EGA, or an other funding arrangement, an OFA. Please refer to the Common Model video, referenced earlier, for definitions and explanations of these terms. Let's start with other funding arrangements. An OFA may arise without any obligation for the grant-providing NPO to transfer resources. For example, a grant-providing NPO may decide to make a donation to a grant recipient, where no written or oral agreement has been put in place, and the grant recipient has no expectation of receiving the resources. Where this is the case, and the grant-providing NPO transfers resources to the grant recipient, a grant expense is recognized when the resources are transferred. The grant expense is measured at the carrying amount of the previously controlled resources. Where the grant-providing NPO does have an obligation to transfer resources, but it has not yet transferred them, it will need to create a liability. Similarly, if the grant-providing NPO has a constructive obligation to transfer resources, this will require the recognition of a provision. In both cases, a grant expense is recognized at the same time as the liability or provision. The grant expense and liability or provision are measured at the amount that the grant-providing NPO is obliged to transfer to the grant recipient. The grant-providing NPO will settle its liability or provision by transferring the resources. An OFA may include constraints on the grant recipient's use of the resources. Such constraints could be about an overall purpose, about a region where resources can be applied, or refer to a time period in which resources must be used. In an OFA, by definition, the grant recipient's entitlement to the revenue is not dependent on it achieving specified outcomes, or carrying out certain activities or actions. For that reason, there is no present obligation on the recipient, and any constraints in the agreement do not normally affect the recognition of the grant expense. The expense will still be recognized on the transfer of resources, as the grant recipient will be expected to meet the terms in the agreement. At a future date, the grant recipient might breach the constraints in an arrangement. For example, imagine a grant that has constraints, in that it can only be used on the objective of providing education. It is only if the grant recipient uses the funds for a different purpose, that they might have a present obligation to make good the failure to meet the constraint, or provide a refund to the grant-providing NPO. If the grant recipient has a liability, then the grant-providing NPO may have a corresponding asset. This asset could be a financial asset, such as a refund due, or another asset, such as a right held by the grant-providing NPO for the grant recipient to carry out an activity. Now let's turn to enforceable grant arrangements. Where there is an EGA, the grant-providing NPO will first need to identify each of its distinct grant fulfillment rights. Each grant fulfillment right will correspond to an enforceable grant obligation, an EGO, for the grant recipient. Activities supported by grants are often interrelated and interdependent. For example, a humanitarian program run by a grant recipient may include project management, procurement, and the delivery of services or goods to individuals. Where this is the case, related rights and obligations may be aggregated until this produces a distinct grant fulfillment right. Next, the grant-providing NPO will need to determine the standalone amount that it is obliged to pay the grant recipient for meeting each distinct grant fulfillment right. It is necessary to wait until one or both parties begin to fulfill their obligations before recognizing any expense, asset, or liability associated with the EGA. So, for example, although an EGA may be in place for a grant-providing NPO to fund the salaries of a grant recipient, if those staff members have not yet been recruited, and no payment has been made by the grant-providing NPO, neither side will have begun to fulfill their obligations. A grant expense is recognized by the grant-providing NPO when a grant fulfillment right is met. This occurs because the grant recipient has satisfied an EGO. The grant expense is measured at the standalone amount of the grant fulfillment right that has been met. The total amount that is payable under an EGA may not be known at the beginning of the arrangement. The amount that the grant-providing NPO is obliged to transfer may vary for items such as incentives or penalties. For example, an additional payment to the grant recipient if it meets its EGO within a specified period. The grant-providing NPO's obligation could also vary if it is contingent on the occurrence of a future event. For example, the payment may be conditional on the grant recipient securing additional funding from other parties. The possibility of different amounts being payable is known as variable consideration. Variable consideration in an EGA means that the grant-providing NPO may have a liability of uncertain timing or amount that meets the definition of a provision. Where a grant-providing NPO has concluded that it has a present obligation to make a payment, it will need to estimate an amount of variable consideration. Making the estimate will most likely require defined information from the grant recipient. After an EGA has started, the amount that a grant-providing NPO is obligated to transfer to the grant recipient can change for various reasons. These can include the resolution of uncertain events, or a change in the rights and obligations that were approved at the beginning of the arrangement. This can lead to either a change in scope of the EGA, a change to the amounts, or both. This is not variable consideration, which would have been set out in the original arrangement, but a change to that arrangement. Changes may result in different amounts being allocated to grant fulfillment rights that have already been met. If a change results in a higher amount being allocated to a grant fulfillment right, an additional expense is recognized. Conversely, a change that results in a lower amount being allocated results in a reduction to the expense already recognized. Such adjustments would take place when the change is approved. If a grant-providing NPO transfers resources before the grant recipient has met its EGO, it recognizes a prepayment asset. This is measured at the total carrying amount of the resources that have been transferred. When the grant recipient meets the EGO, the prepayment asset is derecognized, and a corresponding grant expense is recognized. If a grant recipient meets an EGO before the grant-providing NPO transfers resources, the grant-providing NPO will need to recognize a liability. This will reflect what it owes for each of the EGOs that have been met. The grant-providing NPO will need to recognize a corresponding grant expense. This will be measured at the amount of the resources that the grant-providing NPO is obligated to transfer. Where the grant-providing NPO transfers resources in advance, it is possible that the grant recipient becomes unable or unwilling to meet its EGOs. If this happens, the grant-providing NPO will need to reclassify its prepayment asset. If the NPO has a right to a return of the resources provided, it will be a receivable, which is a financial asset. Otherwise, the grant-providing NPO will need to assess its prepayment asset for impairment. EGAs may be payable over a period of more than 1 year. Where a grant-providing NPO has a present obligation to transfer resources, because the grant recipient has met its EGOs, it recognizes a liability and grant expense. This will be for the total amount of the resources to be transferred to the grant recipient. And it must be recognized, even if the payment is not due until a future reporting period. Where the grant-providing NPO does not have a present obligation to transfer resources in future years, because the grant recipient has not yet met its obligations, the grant-providing NPO will not recognize a liability and grant expense. Where the grant-providing NPO has discretion to avoid grant expenditure in future years because of terms in the EGA, it should not recognize a liability, because the grant-providing NPO does not have a present obligation to transfer the resources. For example, a grant-providing NPO may have made a commitment to provide grant funding over a number of years, but has the right to terminate the EGA. If the likelihood of termination is real, then a constructive liability is unlikely to arise for payments related to periods after the review date. An EGA that requires the grant recipient to acquire or construct a non-current asset, that the grant recipient will then control, is termed a capital grant. The approach to recognizing a grant expense involving a capital grant is the same as with any other grant expense. Where the grant recipient purchases a non-current asset, the grant expense will be recognized when the asset is purchased. However, where the grant recipient constructs a non-current asset, it is likely that the grant fulfillment right will be met over time, as the asset is being built. A grant expense will be recognized by the grant-providing NPO, based on an agreed methodology for the measurement of progress made. If the grant-providing NPO transfers resources before the grant recipient has acquired or constructed the non-current asset, the grant-providing NPO will recognize a prepayment asset until the grant fulfillment rights are met. This prepayment asset will be derecognized when the non-current asset is acquired or constructed by the grant recipient. If the grant recipient acquires or constructs the asset before resources are transferred, the grant-providing NPO will recognize a liability and a grant expense for its obligation to transfer resources. There are a number of practical considerations that a grant-providing NPO needs to consider with EGAs. Firstly, when developing the agreement, a grant-providing NPO should ensure that the enforceable rights and obligations are clear. It should also clarify the consequences of not satisfying those rights or meeting those obligations. Ideally, the agreement should also specify the standalone amount of resources that the grant-providing NPO will transfer for each grant fulfillment right. Where this is not explicitly stated, the grant-providing NPO will need to determine the best estimate of the amounts that would compensate the grant recipient for meeting each of its obligations. This will depend on the quality and type of information that is available. For example, there may be budgets included in the EGA. Otherwise, it may be possible to derive estimates from standard pricing lists. An EGA will also require monitoring arrangements so that the grant-providing NPO can determine if, when, and how the EGO has been met by the grant recipient. The specific terms of the agreement should make these monitoring requirements clear. Monitoring arrangements should also enable the grant recipient to demonstrate that it has met administrative requirements, such as compliance with any stipulations relating to procurement processes, money laundering, or modern slavery. These kind of administrative requirements are not, of themselves, EGOs. This basic example demonstrates how the recognition and measurement requirements are applied. A grant-providing NPO enters an EGA with a grant recipient to provide $100 to fund a vaccination program. The grant recipient must vaccinate at least 90% of a defined community. This is the grant fulfillment right of the grant-providing NPO and the EGO of the grant recipient. The grant-providing NPO provides half of the resources to the grant recipient in advance to fund startup costs for the vaccination program. The other half is due when the EGO has been met. The grant-providing NPO recognizes a prepayment asset of $50 when it transfers the startup resources to the grant recipient and reduces the cash balance accordingly. 6 months later, through monitoring arrangements it has put in place, the grant-providing NPO is notified that the grant recipient has achieved a 90% vaccination rate. The grant recipient is now entitled to payment of the remainder of the grant. The grant-providing NPO transfers a further $50. At the same time, it derecognizes the prepayment asset it originally created and recognizes a grant expense of $100 in the statement of income and expenses. The principles and examples we have just covered only apply if the grant-providing NPO is acting as a principal. It is therefore important to determine whether an NPO is a principal or an agent in an arrangement involving grants. A grant-providing NPO is a principal when it controls the economic resources in a transaction. In that case, the recognition and measurement requirements for grant expenses that we have examined will apply, and grant expenses will be recognized accordingly. An NPO is acting as an agent for another entity if it does not control the economic resources. In that case, the recognition and measurement requirements for grant expenses will not apply. A grant expense will not be recognized when resources are transferred. Instead, the only expenses to be recognized will be those incurred in the administration of the agency arrangement. Similarly, any assets related to the agency arrangement, such as funding provided to the grant-providing NPO, do not form part of the grant-providing NPO's own assets or income. Disclosures will provide transparency about these arrangements. Disclosures provide users with information to enable them to understand the nature, amount, timing, and any uncertainty arising from grant expenses. NPOs must provide the following information: an overall description of the purpose of the material EGAs or OFAs, the existence and potential consequences of variable consideration, significant payment terms, and the nature of the resources transferred or transferable. Additionally, the grant-providing NPO must provide the following specific disclosures: the amount recognized as grant expenses in the statement of income and expenses, and amounts financed from revenue classified to funds with restrictions. Amounts shown on the statement of financial position as EGA-related prepayment assets, liabilities, and provisions. Any commitments to provide grant funding that are not recognized as liabilities. And, if acting as an agent, further disclosures including details of any balances held as an agent, the name and objects of the entity on whose behalf the balances are held, and why the grant-providing NPO is acting for them. A grant-providing NPO is exempted from making disclosures about grant expenses, where these are sensitive. A disclosure is sensitive if, for example, describing the nature of a grant made would compromise the safety or well-being of individuals, such as those working with the grant-providing NPO or grant recipients. A disclosure could also be considered sensitive if it could prejudice the ability of the grant-providing NPO or grant recipient to deliver its mission or purpose in other ways. The exception to not disclose sensitive information cannot be used to avoid disclosures that might identify failures in organizational governance, performance, or financial management. A grant-providing NPO will remain in compliance with the requirements of INPAG, where this exception is utilized. However, this does not reduce the general requirement to present information related to grant expenses that does not result in sensitive information. This video has provided an overview of the proposals in INPAG Section 24, Part 1. It has highlighted the difference between grant expenses and purchasing, and how grant arrangements are classified, that is, as other funding arrangements and enforceable grant arrangements. For other funding arrangements, recognition will usually be when resources are transferred to a grant recipient, measured at the carrying amount of those resources. For enforceable grant arrangements, recognition will be when a grant fulfillment right has been met, because the grant recipient has satisfied an enforceable grant obligation. The grant expenses will be measured at the standalone amount allocated to each grant fulfillment right. Disclosures are focused on providing users with information to enable them to understand the nature, amount, timing, and uncertainty arising from grant expenses, subject to an exemption for sensitive information. We look forward to hearing your feedback on the proposals in Exposure Draft 2. The invitation to comment includes specific questions on the proposals explained in this video. To respond, visit www.ifr4npo.org/have-your-say. Download a template response document and upload your completed response or comment letter. Responses must be in English. The deadline is the 15th of March 2024.